You weren't with us yesterday, but I was quoting you because you were vigorously posting and writing about the impact of this court order on the Trump administration's tariffs. Since you initially wrote on it, we've now heard the Trump administration say, we're going to find an avenue one way or another to impose these reciprocal tariffs. What do you do with that from a market perspective?
You have to assume the tariffs will stay in place. The difficulty with trading during the Trump administration, it's not like trying to navigate a ship through the usual tides of the sea. It's more like a storm. The winds change every day. You've already mentioned Section 899. We'll come on to that. There's a new storm that's brewing in markets. But when it comes to the trade tariffs, we understood that the administration would look to have a stay of execution, which means the tariffs will stay in effect until the outcome of that appeals process has been heard. So it could be the case that after the appeals heard, if it gets struck down or if it gets upheld, we'll then have to make a decision. But that's a process that will take months. So for now, businesses and firms and importers in the US most especially don't have that luxury of lower tariffs in the immediate term. They have the same tariffs that were in place before.
You bring up Section 899. Carolyn flagged it in the read out to you. We're seeing so much attention on it now in the last 24 hours. Just how impactful would this piece of legislation be if it does get through the Senate in its current form?
Yes, you can read through all the different legal scholars who've written on the topic now, about 5 to 7 days worth of articles out there. So it's been under the surface, but with Trump, of course, flooding the zone and also the court case yesterday, it's very easy to get distracted and miss this. This could be something that's extremely important, especially for foreign holders of US assets in countries that are deemed to have discriminatory foreign tax policies. Now, the digital services tax in Europe stands out as number one on the list of things that could be considered. But there's other forms of taxation, such as minimum taxation that countries have on corporation tax, for example, that could be deemed to be unfair. Now, there's been a lot written on it, but essentially you'll have a higher tax rate for foreign holders of US assets. If it was triggered, it'll target not all holders of US assets, but those in the certain country that has been targeted. And it would start at 5%, and it'd ramp up a 5% extra tax rate above the usual tax rate over the next 4 years to a maximum of around 15–20%. So it's very, very important for US holders for foreign holders of US assets.
And that means more capital flight from the US to other countries. And would this essentially, Jordan, would this speed up the thought of de-dollarization that's been around for ages? It hasn't quite come to fruition because that is still the reserve currency, but would that play into the narrative?
Well, let's look at who are the largest holders of US treasuries, for example. Of course, it's China, Japan, and the UK. Now, the UK is a foreign destination for banks, so it's partly due to its jurisdiction in that respect. But let's say the UK, for example, got targeted with that. What would you do? You'd move your assets out of US of equities and of US treasuries. So it would have a big impact. And that's why I think the threat of it alone is enough to spook the markets, and it probably wouldn't be used as much as we fear.
That is the long-term trend, though. If we take a look at the short-term trend for the U.S. dollar, we just heard for the month of May, it's essentially flat since the start of the year. I think it's still down 5 to 7% or so. But you in your notes, you say, watch out for a bounce in U.S. data surprises. We didn't necessarily get a positive surprise in yesterday's GDP data or the jobless numbers, but less Fed cuts priced in and a tactical rebound in the U.S. dollar. So short-term, expect some strength in the greenback?
Yeah, short term. Long term, we're of the view that euro dollar gets to 120. So we're in the camp of dollar weaker in the second half this year. But I just worry because I have these charts that show me positioning. Everybody's short the dollar. I don't think you've probably had any guests on here arguing for a long dollar. So that's the story. When everyone's on the same trade, you just need a few positive data beats and then you have a squeeze. Every day is different. Every morning is different each afternoon in the FX market. Just look at yesterday. So it's a very difficult market to trade, but I'm just cautious about adding to dollar shorts here.
Everybody short the same thing, so it doesn't take much to get a short squeeze. But let me come back to your point about Japan being one of the key foreign holders of U.S. Treasuries, because there's been a lot of focus in the last couple of weeks on the Japanese bond market, yields moving higher in Japan here, and wondering how much of a tail risk you think that Japan represents and the read-through that has for the U.S. dollar.
I don't think it's a tail risk. I think it's a base case that we expect higher Japanese yields. And what that will mean for the US curve is quite substantial. For a long time, we had low interest rates in Japan funding carry trades, and being long US assets, as Japanese investors are, has been a key part of that. But if your domestic market as a Japanese investor suddenly has attractive rates of return in the long end, Why would you need to invest in the US with all this uncertainty? So you're going to see less investment in US treasuries, and as a result, by Japanese investors, and you'll see higher US yields on the back of that. So we've got US 10-year going to 5% by the end of the year, apart for many other reasons. The fiscal is a part of that, but this is part of that story as well.
And you have Euro USD going to 120. When do you see that happening? I
think that's going to be a late Q3, Q4 story. Over the summer, we've actually got the issue of, I think we'll see weaker European data because of the tariffs and the impact that will have from July onwards when the higher rates are effective. We'll have a more dovish ECB as well over the summer. But then we get to late Q3, Q4, the Germans should have passed a budget by then. We'll have the fiscal stimulus expectations ramp up and growth expectations, and that gets us to the 120.
Leave us with your best trades as we head into the weekend. Hopefully everyone's taking some time off after this very hectic week. How do you want to play the U.S. curve, and how do you want to play the Japanese yen?
Well, we talked about the euro. When it comes to the US curve, I think what's quite clear is we're not going to get Fed cuts this year. And I think investors are slowly coming around to that trade. Now, clearly just paying the very front end of the curve, Z5 in the SOFR space, is one way. But what I really like is I know that this market loves to price in rate cuts down the line because we are late cycle. Everyone seems to be a dove on the Fed. So what we should see is less cuts this year, but more cuts priced for next year. So we've got flatness in the very front end of the SOFR curve and Fed funds. And then for the Japanese yen, I talked about higher Japanese yields. We're looking for Bank Japan rate hikes. So we're looking for dollar yen to get down to 138 to 136 by March of next year.
But that's not really priced in, is it? The rate hikes?
Well, you've got a 50-50 chance of an October hike. Right. I think it's quite likely it will happen.